.com.au, and we will try to answer any questions that you flick through to us. In the meantime, though, let's get straight into the performance of the market today. Julia Lee, not the best of starts. Once again, it is macro issues dominating sentiment.
Europe is what's on everybody's minds at the moment. In fact, in terms of US market performance, we've now seen 5 consecutive days of gains. But of course, it was developments over the weekend which dominated today's market session. In particular, worries over Greece. We did see that Eurogroup meeting in Poland. No huge announcements made out of that, but it does look like the Greek Prime Minister cancelling a trip to the US, instead back into Greek Parliament to talk about spending cuts. So we did see a massive downturn in terms of the US futures during our session, down by about 1.6%. Every single sector on the Australian share market traded lower. In fact, if we have a look at the gainers versus the losers, we saw twice as many stocks falling as we saw gaining today. The worst sector was the energy sector, down by 2.6%, but also a very light day with only $3.6 billion worth of stock being traded. And part of that is that Japan is on holidays today. But one bright spot, which comes as a bit of a surprise, were the retailers today. We saw Premier come out with its full-year result. Its stock up by 1.6%, but that's not the only retailer that was trading higher today. We also saw JB Hi-Fi gaining 1%. We saw David Jones gaining 0.4%. Kathmandu, one of the best performers, up by around about 2%. We also saw Kathmandu up by about 3%. We also saw Origin Group up by 2%. So it does look like a little bit of that negative sentiment which has been dominant in these retailers for the past year, starting to see a little bit of positive sentiment come through. One stock which didn't participate in the gains of those retailers was Billabong, down by a massive 7.6%. It, of course, has exposure to Europe, which is very much in focus at the moment. So altogether, a pretty bad day for the markets. We saw some safe haven buying going on with the gold stocks, but also the retailers surprisingly doing well.
Greece will qualify, if you like, for the next tranche of the bailout fund. I mean, is it at all conceivable that they wouldn't give the next handout? I mean, the Greek leaders have already said they can't really make it until the end of they can make it till the end of October, and then it's all bets off.
If we have a look at credit default swaps, they are pricing in a 99.9% chance of a Greek default. I guess the problem with the Greek default is it going to be contained to Greece, or are we going to see the other pigs also participating in that? So I guess over the weekend, a number of key developments. We know that Greek officials have been talking to IMF, EU supervisors, hoping to get the next tranche of their bailout funds. And one of the things I think that the markets were quite scared about today was the news flow coming over the weekend in terms of Greece and in terms of Germany as well. We have a look at the news flow in terms of Greece. We saw the Greek Prime Minister cancelling that trip to the US. We saw an emergency meeting in the Greek Parliament last night talking about extra spending cuts. And of course, there's still being monitored the situation with the Troika, or the IMF, the European Union. If we have a look at who pays for Greece's problems, I guess the first country that comes to mind is Germany. And if we have look at the news flow out of Germany over the weekend, once again seeing bad news. It looks like Merkel has lost another regional election, so that's been seen as a negative. But also the German Parliament, which was due to vote on the European Financial Stability Fund on the 16th of December, has pulled back their schedule. They're now looking to vote on that in the first quarter of 2012. So the market very worried about whether Greece is going to be able to get its next tranche or the next level in terms of that European Financial Stability Fund and the second bailout. So that's all up in the air as well. And then add to the mix, you know, Moody's was supposed to come out over the weekend with its review on Italy's debt rating. In June, we saw it put it on our ratings review, and usually they take 90 days to review the debt rating, and of course that expired over the weekend. Moody's coming out to say that they are going to provide an update within the month, so the market's still watching that very carefully. And then, of course, secondary to that is what's happening in terms of the US situation. We have seen deteriorating data for a while. We're going to see Obama coming out tonight. He's going to probably announce the Buffett tax, that's a tax on extra wealthy incomes of more than $1 million. And then later on in the week, Wednesday, Thursday, we see the FOMC special 2-day meeting, then Bernanke's speech on Thursday, and the market really pricing in Operation Twist, which is just the Federal Reserve going into buy those longer dated treasuries.
Bill Edell.
I think Premier Investments, the strategic review that came through a few months ago was an interesting one. And I think they're managing costs really well. They're looking at improving their gross margins. Yes, it's a difficult environment. We are seeing both cyclical as well as structural pressures. But Premier has a lot of cash on its books. It's in a good place to go shopping for cheap assets in this environment, a strong dividend yield. So I think this one would have to be a long-term buy, because in terms of the cyclical issues, I don't think we're going to see a turnaround in retail for 12 to 24 months. In terms of the structural issues, this is going to be a much more interesting one. We know that Westfield has an online model that it's been promoting. Myer's going online, and it'll be interesting to see whether it can translate its exclusive brand strategy into an online model. And I think it's a relatively new space. So the next 5 years, we're going to see key players, I think, emerging in this online space.